Hello, my name is Maurice Washington. I want to welcome everybody to another episode of Executive Talk. Those who are watching live and those who are listening later on our podcast, thank you so much for joining us in today's segment. Today's segment is titled 2026 Business Insurance Market Overview. It's important, business owners, that we take a step back. With life going as fast as it's going, it's hard to really keep up on what's important and what's moving behind the scenes. And business insurance and your policy is one of those things that's moving behind the scenes. So with me today is we have Rick Callaway. He is a business specialist with Acrisure Business Insurance. So without further ado, let's go ahead and bring Rick to the stage. How you doing, Rick?
I'm doing well, thank you. Been looking forward to this. 2026 is off to a strange start with insurance.
Isn't that a fact? I mean, there's so many events going on in 2026. Your head will spin. But that's why we have you here to actually talk about this last year. And one thing that Rick and I do for the audience that's watching, want to make sure you understand, each year we actually go through these reviews because it's important. Each year is different. Each year there's something new that's happening with life, as we're recognizing right now that we need to pay attention to, and it has a cause and effect on insurance. And so just on a bigger scope, Rick, because we're about 6 months into the year, has business insurance been changing, would you say, pretty rapidly?
For insurance, it's definitely changing rapidly. Obviously, premiums change regularly. What they base their underwriting on changes. And I've been doing this for close to 40 years, and it never ceases to amaze me how quickly it changes. What's good last year is not so good this year.
Exactly. And so let's go ahead and get into this. And we have market transition dynamics for 2026. So you have sector stabilization and pressure. Property insurance sectors begin stabilizing with returning capacity, while catastrophe exposed risks face continued scrutiny. We have strain in the casualty and health lines, innovation and regulatory challenges, and market complexity and strategic response. Take us down that pathway, Rick. What are you seeing with that?
Well, the stabilization it's slightly stabilizing in property rates. They're still high, but at least they're not keep going up. Catastrophe exposed risks, flood, fire, earthquake, and California's fire. And what they're considering brush areas is expanding. If you got a twig in your front yard, that's now a brush area. So they're looking at that and how they rate it. Casualty, auto, health, everybody complains about their health insurance. The rates going up, their auto rates going up. This is based on not the profitability of the insurance companies, is actually the lack of profitability. That claims cost is going up faster than anything else.
Gotcha. Okay.
And that's what social inflation is. It's the cost of claims that are going up faster than the actual rate of inflation.
Okay.
I don't know. Innovation and regulatory challenges is strange things to put together. The insurance companies keep innovating how they do business, and regulatory keeps trying to slap them down and say, no, you can't do that. You can't do this. So they're fighting through all those changes to make their products competitive. And then marketplace complexity. All insurance companies look at what are going to be their most profitable areas of insurance. So they look at property, they look at general liability, they look at, climate risks. Are there chances of being big storms there or earthquakes in California? Knock on wood, haven't had an earthquake in California in a while. So
right.
I'm happy about that.
Right.
My house is still standing. But
yes.
And insurance companies don't make their money off of premiums. They make it from claims not being high and their investments in the marketplace.
Gotcha. Okay. All right. And so again, folks, just trail with us because this is developing the story. Because this is the story that Rick is talking about, are things that are decisions that are made behind the scenes. And this is where people fall asleep when it comes to insurance. You think it's something that is, okay, I got insurance, I'm completely good. But as these things changes, these are cause and effects as to why you're seeing your insurance rate increase. This is why some of the people are getting declined when they used to be able to become or were insured. A lot of insurance companies, and we see this right here, we have innovation and regulatory challenges. Insurance modernized with AI and data analytics while navigating evolving regulations and AI governance and consumer protection. So we have insurance companies using AI and data analytics to put some of this stuff together, which is coming up with some of their decisions and choices, right?
Yeah, they take a look at, say they're looking at California, they'll take a look at in what areas are claims highest for this, that, or the other thing. And then AI goes in there and analyzes the data and says, hey, you better not quote anything in this area or modify your rates for this area. So that's what's happening. They analyze the data on the claims to figure out what's happening. And that's the only way they can analyze it. And fortunately, they're analyzing it. And hopefully in a couple of years, they'll have this AI stuff down and the actual cost of insurance will go down because at one point they said, okay, you're writing insurance on a house. Every house is going to have these potential claims. So they base it on that. Now they know houses over here are not going to ever have any of those claims. So they look at the risk, where it's located, to determine what data to apply to the insurance for that risk. And they have to do this ahead of time because they have to file their rates in states.
Yeah, that's right. So again, look at all these factors, folks. That's behind the scenes. This is important. So we have key drivers influencing the market conditions in 2026 and persistent claims inflation, social inflation effects. Go ahead and talk to us about the persistent claims inflation, Rick.
Well, as people get more, first we'll talk about auto. As cars get more and more expensive, they get more and more difficult to repair, so that costs more. And they have to get technicians that are trained on all of the new modern things. I mean, I was a diesel mechanic. I used to be able to open up a hood and figure out what was wrong. Now you open up, you've got a bunch of tubes and chips running all over the place. Health lines, what's driving some of that cost is we're living longer. So we've got more potential to get, specific diseases or whatever. And all the research is, curing cancer by adding additional treatments. So that somebody has to pay for that. So guess what? And they have to spread it across all the ratepayers. They can't charge you 3 times as much because you had cancer once. And then we already talked about the social inflation. The claims are going up faster than normal inflation. We also talked a little bit about weather.
Yeah, we're going to talk a little bit more about weather, but go ahead.
Yeah, it seems like in high risk zones, areas that are prone to earthquakes, prone to floods, prone to hurricane, they seem to be more severe. So they're analyzing that. And they're specifically narrowing in on high risk Californians. If you're looking to insure for earthquake, they're not really worried about it in Kansas. But if you're looking for tornadoes, they're looking for Dorothy riding off to Oz. They're looking at that in those places. So they look at each area, what the high risk zones are, and analyze that. And we already talked about regulatory. The government keeps changing its rules and regulations trying to help the consumer, yet they have no real understanding of how insurance works or how these changes work. If they tell them, hey, you've got to write insurance in all these areas, you got to do all this, insurance companies can say, you know what, we're just going to leave the state or stop insuring those kinds of risks. State Farm, Farmers, Nationwide, and a couple others have pretty much pulled out of California. So, that's less markets to put business with. So, more markets means more competition. Less markets mean zero competition. Florida lost all of their carriers.
Yeah, I was going to say Florida.
Yeah, they're starting.
So, and I apologize about interrupting you, but this is a huge question here, Rick. I remember a couple of years back, we were talking about Florida at one point because they were going through a lot. And a lot of the carriers were pulling out of Florida. Has that changed over the years? I mean,
they're gradually coming back. They've figured out how to underwrite things. And I think they've had some favorable regulatory things. The state government in Florida understands that you can't You can't regulate lower prices. All you can do is cripple it when you put in regulation. You have to let the free market dictate, not regulations. If I've got too many regulations, I'm not going to do business there. It's too costly.
Yeah.
I got to have 12 lawyers on staff to do everything.
Gotcha.
I'm not
Okay.
I'm not fond of the regulatory agencies.
That's true, but we have them here. So again, it's
Yep.
important for people to understand those risk factors. So we do appreciate you breaking it down for us. So for here, you have projected performance indicators through 2026, and we have steady ROE improvement. PNC insurers forecast near 10% ROE through 2026, fueled by property market stabilization and disciplined casualty underwriting. What does that mean for folks? How do they look at that for their insurance needs?
Contrary to popular belief, insurance companies don't make most of their money off of premiums. They make it through their investments. So if they get a good return on equity, they don't have to raise premiums. If they're not getting a very good return, then the opposite happens. They have to increase because they've got hundreds of employees and offices to maintain. So they have to have enough money so they can make all that happen or they're gone. And the biggest thing is they have to have money to pay the claims. That's where they need that good ROE.
Gotcha. Okay.
Where it says the insurance rate trends,
Right.
I don't know if they're getting moderate profitability or not. I think they're still struggling with all the catastrophic losses and trying to figure out how to rate things in today's marketplace so they have the right amount of premium versus investment versus claims. So it's
Okay.
it's a financial marketplace. Yeah, they insure you if your building burns down, but what they're looking at is the data. It costs X amount of dollars to build it, so they plug that in somewhere and keep track of that. So that's how they determine what's going on.
I do remember we were talking about this one, reinsurance, risk management and reinsurance. Insurance emphasized rigorous risk selection, advanced pricing models, and reinsurance strategy adjustments to manage market volatility.
Yeah, it's probably unknown to most people unless you're dealing in this wonderful world of insurance. Every insurance carrier charges a premium, and say you've got general liability for $5 million. They may only insure the first $1 million of that, and then they'll get the rest through reinsurance. And if there's a bunch of large claims, then the reinsurers look at, we got to adjust our premiums up. Like the Twin Towers, I think that had something like 30 insurance companies on it at different layers. So the first $1 million pays off, then the next $1 million, the next $1 million, the next $1 million, whatever. So that's what reinsurance is.
Okay. All right. And then we have market dynamics impact. E&S carriers absorb high risk policies.
Yep. E&S carriers is the excess and surplus lines market.
That's right.
And they take the risk that the standard carriers don't want. So they're already looking at high risk carriers. Or in California, a building is considered old if it was built in 1990. So that means it eliminates them from the standard market. I mean, hell, I've got buildings that were built in 1909 that I've had to shop all over the place. Even though they've been modernized,
Sure.
Updated electrical, plumbing, roof, whatever, the insurance companies still look at that original construction date. They take into consideration the improvements, but they're still looking at it was built in 1909. Hell, if it was built in 1909 and it was in San Francisco and it's still standing, that's probably a pretty good risk because it lived through the earthquakes and the fires and all that. And there's a difference in construction. You've got, masonry, you got wood frame. Wood frame is obviously higher risk because it's got the more potential to burn. The masonry is lower risk because concrete and rocks don't burn very well. So that's a lower risk.
Right. Yes.
Then I have
a question for you.
Okay.
Because we're talking about commercial, and we had a commercial broker come on maybe a year and a half ago, and we were talking about, because at that particular time, COVID was, at its peak, and a lot of people started working from home, and people started to abandon the commercial real estate market. with the commercial real estate market the way that it is right now, I'm not really for sure if people have returned back to office space, but when those commercial spaces are, are not under a high percentage of leasing and occupancy, do those insurance rates are they increasing because of that?
If you've got a building that had 100% occupancy, COVID came on, the insurers didn't really consider it vacant or empty because of COVID. But then as people started coming back and there was less occupancy in the buildings, the insurance companies rewrote it completely because vacant buildings are prone to things like vandalism, theft, whatever. And
That's
also the lenders looked at occupancy rates because their loan getting repaid is based on you having, 70% occupancy or whatever. So you have enough money coming in to pay the loan off. So vacancies are not good for a couple of reasons. They're nuisance risks, and they've reduced the amount of money coming in to the person who owns the building. So we're seeing a lot of buildings being repurposed from what they were to what they are now. They were trying to convert some of these buildings into condominiums, but it was just too costly to do because they had to run new electrical, new plumbing, new everything to the individual units. And they realized after they'd messed around with it on one building, they said, maybe this isn't such a good strategy. We've got to figure out how to get commercial risks into this building, either lower rents, extra services, but real estate, like insurance, is based on people inhabiting a space.
Yeah. And so I brought that up for a specific reason. There are a lot of folks out there that have a commercial space that they're leasing in order to do their business. This is one of those reasons in the back end that's affecting your rates currently. So again, insurance looks at every last bit of, all the dynamics that are going on into your rate. So just remember that. And again, this is why you get with folks like Rick to talk to them. We have this evolving conditions in the excess surplus segment. So we just talked about that for a minute. So market resilience and growth. The E&S markets shows steady growth and strong capitalization after the peak of its hard market surge and softening property risk rates. Go ahead and take us down this pathway, Rick.
Okay. The E&S market is getting more attention these days than it ever did before. It's got more premium coming in than any of the standard markets because of things like, an old building. We're not going to write old buildings, so that puts it into E&S. Or you might end up in E&S because you're in close to a fire zone or in a tornado area or a flood zone. So that stuff doesn't stay in the standard market. It goes to the E&S market. They seem to have a better handle on their underwriting. They'll write lots of things, and some things that said no thanks, we don't want it, or they'll price it very high. I've got a poor guy that he's got a beautiful apartment building in Los Angeles. It's 19 or 20 units, I don't remember what, but his premium was around 20,000. All of the pricing I'm getting now is 45,000. So I'm scrambling to try and figure out how to reduce his premium. In fact, we got an extension on his current policy so we could keep searching. I've been to almost every market in the world, and I'm still looking for more because. And
just to clarify, Rick, I need to understand this and have the folks that are watching understand. E&S, excess and surplus, that is for when the standard insurance won't accept their business. This is where you look at other alternatives. Is that what I'm understanding? Is this how people need to understand this?
You're understanding 100% correctly.
Okay.
If you're operating a circus with a bunch of elephants parading around, chance for those elephants stomping on stands and people is a pretty high risk. You're not going to find a place to put it in the standard lines, but the excess and surplus lines will take it, and it's going to be a higher premium than you ever had before. But you need the insurance, and just like you're trying to make money and keep your business stabilized, the insurance companies are doing the same thing. And regulatory agencies don't understand that I need to be able to price different things at different rates and I need to move the premiums up over here and maybe keep them level or go down over here. So they look at all the risks. And well, for excess and surplus lines markets are carriers that are in every state, but they haven't signed on to be an admitted carrier in that state because of regulations. They don't want to deal with the state regulations. They'll continue to be an excess and surplus lines market. And there's a listing of all of these carriers online if somebody really wanted to know who they were. And they're larger than some of your household names like Travelers, Hartford, Hanover. Just because they're in the excess and surplus lines market doesn't mean they're inferior carriers. It just means they've chosen to do business a different way. And now it's becoming to their benefit because regulations are driving standard carriers out of the marketplace.
Yeah. And what Rick had brought up that example of the circus and the elephant, and I know it sounded funny, but I want you to think about what he was saying. There is a dynamic to your business that you may not be paying attention to. So the more creative your business, the more risk the insurance company is going to look for. It's something that you don't think about, but it's something the insurance companies are thinking about. They're looking at some of those details that are unknown, and because you're just thinking about this exciting business. The insurance company, when they look at your business, they look at all the creativity that's involved in it when it comes to insuring and all the exposure that they're getting involved in. Does that sound about right on how you're explaining it, Rick?
That sounds correct. If you own a circus, we'll go back to that. You're around your business every day, and the elephants and the lions and the tigers and the clowns and all that just seems normal to you because you're in that business. But the insurance company goes, holy cow, you got wild animals and people in cages and people walking around on high wires. And we gotta look at how this insurance is working. If someone fell off the high wire and landed on the ground, that's not a claim for the E&S thing. But if they fall and land in the stands and someone gets hurt, that's going to be an insurance claim for sure, because somebody falling from that height is probably going to damage not only themselves, but the person they landed on.
That's right. But so think about those that, go ahead, Rick.
Please. The high wire people don't worry about falling. If they were worried about falling, they wouldn't be up there walking around.
That's right. Think about that, folks. As you explore your business, you may think it's simple to you, but to the insurance companies, they see risk. What is that little detail that you're not paying attention to that is going to expose the business and the insurance company to a claim?
Yeah, how you do things in your business seems obvious to you, but then the insurance company looks at it and goes, that's pretty high risk. You got this guy reaching into a machine and trying to pull something out. Maybe you should change the way you do this. So yeah. I've got a team. I'm working in some of the manufacturing markets, and I have a team. They're nothing but risk managers. They'll go in and inspect a site and say, hey, you know what, maybe we ought to change this. This might make this better. Maybe we ought to have, safety on the job is nothing more than reminding people to be safe. Don't leave that extension cord running across the floor. Don't jump across the conveyor belt to get to the other side because you got to go to the bathroom, walk around. So simple things that people do every day when the risk person comes in and looks at it, go, yeah, that's not such a good idea to be doing that. So they'll give suggestions on how to keep your operations safe.
This one, and I know how society has beat up weather. Although weather is doing what weather is doing, we're still fighting it as a whole. Doesn't mean the weather does not care about our politics. The weather does not care about how we view it. The weather is going to be the weather regardless of what's going on. So I want everybody to really take themselves out of today's climate and look at the insurance company and look at what the weather is doing to a lot of places. One thing that I can be rest assured, and we'll talk about some of these details to make sure we stay in line with everything. Colorado has experienced a huge drought for an insurance company. And when you think about, Rick was talking about California, they had fire. there's a lot of, and we were talking about Florida earlier in today's conversation. There's pockets around the states that have specific weather-driven conditions that create losses.
Yeah,
and so, go ahead, Rick.
Weather changes cyclically. We haven't done a darn thing to affect it. The Earth has been around a lot longer than we have, and Earth has been frozen. It's warmed up, and weather. The only thing that gets really affected, wind, because when you got big buildings going around, it changes the pattern of the wind, so it's going to swirl around and do different things. But rain and floods, rain happens. It's just the nature of the beast. Droughts happen, so now you've got potential for wildfires.
Yeah,
because everything's drying out.
And so some of the points that we brought up here is rising natural catastrophe losses, so frequent severe disasters like wildfires, like Rick just mentioned, and floods cause insured losses exceeding 100 billion annually, stressing insurers. So think about that, folks. Think about that number, 100 billion annually. So if I'm an insurer, Rick, how am I looking at that loss year after year?
Well, that 100 billion is stretched all over all the states. California's wildfires, they could have been prevented had we taken care of the forest properly and raked up and gotten rid of all the dry stuff on the ground. Trees don't burn in the forest. It's all of the underbrush that burns and then starts the trees on fire. So they need to be aware of what the potential disasters are, and they need to mitigate what that risk is, if it's possible. You can't, there's nothing you can do to mitigate a hurricane. It's going to come and go wherever it feels. So you build buildings to expect that, hey, we're going to get 100-mile-an-hour winds. We got to make sure it doesn't blow our building down. So buildings were built obviously completely different at the turn of the century than they are now. So
sure,
engineers understand these things, and they engineer buildings to meet certain stretches. California, with its regulatory folks, have gone completely overboard. I forget which area it was that burned, and it's right on the coast. And all of those buildings were built on basically telephone poles driven into the ground, and the house was built. And they state that they were built in the 30s and 40s like that. Nothing affected. They were still standing until the fire took them out. Now California, in its regulatory brilliance, is requiring that they put caissons in, which are big concrete things dug into the ground and poured, which is more expensive than pile driving. And now they're having to have a 13-inch foundation deck, or whatever you want to call it. 13 inches is enough to support an airplane. So it's overblown. There's only one house that I've seen that's being rebuilt. Realize they haven't started building walls, anything else. They're already into this thing for $3 million because of the new regulations. Most people aren't going to be able to do that because the insurance company isn't going to cover those highly expensive code upgrades. So I don't know what's going to happen on there. How would you like to spend $3 million before you've even put a wall up? So this guy's going to be into this thing, for $5 million, 6,000 square foot. And he obviously has got money because he can afford the first $3 million.
That's fair. Let's bring up this one other point here. So underwriting and capacity responses. Insurance implements stricter underwriting rules, and some withdraw from high-risk markets, causing insurance deserts. That term I've never heard of before. Is that when these insurance companies you were talking about earlier pull out of the market?
They pull out of the market, or they won't write risks that they used to write. That's why everything's moving to the excess and surplus lines market. Okay. Carriers, they look at, all these apartment buildings or factories are costing us a small fortune, so let's not write them anymore. Let's look at doing other things. Or they'll raise rates in other areas. They know they can raise rates in the auto market because everybody's got to have an auto. So they're going to pay, the increased cost so they can funnel that money into their claims pot. Because you got to realize insurance company has a big pot of money, and it comes from all states and all things. So if there's a flood, they're going to take the money to pay for the floods. If there's a wildfire, they take that money to pay for the wildfire risk. But it's one giant pot of money. So they're looking at what areas they're less likely to have large risks in. And some states are requiring, if you're going to write 12 houses in this marketplace, in our state, you got to write whatever percentage that is of the total marketplace, that much of the high risk things. So they're trying to force the carriers to write high risk stuff, which is or is not a good thing, but they're going to have to price it accordingly. I can't afford to write a house in the middle of a forest when I know the damn thing's going to burn down eventually. I need to collect enough premium to cover all that stuff.
That's right. That's fair. So again, folks, take note of these variables that insurance companies think about behind the scenes. And this is one of the major ones. And let me be very clear and give everybody understanding as to what you can see in the future. Rick and I are going to more than likely be addressing AI frequently because it's coming on and it's coming on strong. So operational, regulatory, and liability risks from AI adoption. So we have data privacy and security risks. Generative AI relies on sensitive data, increasing vulnerabilities under private laws like GDPR and HIPAA. Go ahead and take us down that pathway, Rick.
Well, HIPAA probably has the most information on a person. They have their name, age, birthplace, all of that stuff. And if that stuff gets out, you got a big claim because nothing more a hacker would love is to get hold of all that information about a whole bunch of people. Then they can go do whatever they want with it, open new bank accounts, credit cards. So that's very, very sensitive stuff. And they have to be careful. AI goes in there and they use AI to analyze data. They have to be careful AI doesn't open up a port that people can go through. Yeah,
that's true. This is access points, folks. I mean, again, AI is proven to be just like you see on TV. It's cool to have that extra co-pilot or whatnot. And I'm talking about Microsoft. They have that co-pilot. But I want you to think about the vulnerability, the places AI can go. Just really consider that when it talks about this exposure is AI can go to places that you may not be able to go. And so we have bias and explainability challenges. AI models may embed biases, causing unfair decisions, raising regulatory scrutiny, and underwriting and claims. This one's a huge one because, again, I know humans are the people that are training AI.
Correct.
But go ahead and take the ball and run with it, Rick.
The biases are interesting. One company was using AI to scan potential employees, and a bias is built in by the original coder. And it was people I forget the age, maybe it was 50, 45. I don't remember what the age was, but it was automatically rejecting those things until someone said, wait a minute, why are we only getting applications from people that are under 30? Because of that bias that was built in. So they had they got sued, and secondly, they had to fix their model. So you have to be careful. You have to run a lot of tests on these models before you put it into practice, which people are learning now because AI doesn't always know the answer. So, and if it doesn't know the answer, it might make one up. So
yes. And that's exactly it. It's not like it's not going to say, I don't know.
Right.
I very rarely, again, I haven't dabbled in it, but one thing I have heard is that AI will bring up anything that it feels like is being asked to do.
Right. And
you sometimes you have to cross-reference to make sure it's accurate.
Yeah. I use Copilot a lot for my AI stuff, and it shows you where it went to get the information. So if you want to double check something, you go in and check one of those sites. Right now, I use it primarily for searching out information on buildings. I have it help me prepare proposals. That was huge. It used to take an hour at least to put a proposal together. Now it takes me like 5 minutes. I upload the raw quote into AI. It creates the proposal. Then I have to go in and modify certain things so it makes sense.
Yeah, that's fair. And I'm going to bring up this last one. We have accuracy and hallucination risk, which is something I haven't heard of. AI generated errors and hallucinations can cause claim miscalculations and flawed policy advice, increasing liability.
Yeah,
You want to take that, Rick?
I haven't seen this in practice yet, but what it can do, it can be looking at a claim, say it's for a whole building burned down, and AI looks at it like it was just one wall, so it prices it accordingly. And you go, wait a minute, that's enough to put up one wall, but it doesn't help me with everything. Or it'll do the opposite, inflate the claim. Say, hey, the building, this wall burned down, but you're going to have to replace the whole building, so it's now X amount of dollars. So claims people are working with the AI to make sure they don't have those things, because that creates extra work for them. They can figure out how they, and for humans and claims people are used to seeing certain results when there's a claim, and most of them look right away and go, hey, wait a minute, this is ridiculous. Shouldn't cost this much, or it shouldn't be this little, and they go in and adjust it. Like I said, it's humans training it. So they'll take that claim, stuff it back into AI and tell it, this is what you should be looking at here, here, and here. So the next time it happens, they get the right response. And people are scared of AI taking jobs. What it's going to do is allow people to work more efficiently. I mean, if say you're an accountant, instead of having to go through every single spreadsheet and stuff that the client sends you, AI looks at it, summarize it, and say, okay, here's the results from looking at all the stuff, and you can move on. So it's going to make you much more efficient. And
Rick, yet again, you've done a masterful job bringing us up to speed on what's going on in the back end and what insurance companies are looking at here moving forward in 2026. And again, folks, I want to make sure you understand these things that are happening in the background. You need to understand why, so that way, again, you can have that proper conversation. So, Rick, I'm going to give you the floor and give you an opportunity to give folks their final details on what they need to do moving forward with this information that you just provided for them. So go ahead and take it away.
Most importantly, you have to work with a knowledgeable and experienced insurance broker, so he can look at your risk and your operation to help it get priced properly. I mean, I actually insure everything from an agricultural farm to a space station. So I've written a little bit of everything. So I've also run several businesses. So I understand the risk that's involved in your operation and what it takes to make your operation work. I mean, I couldn't come in and operate your manufacturing plant, but I've worked with enough machinery to understand how it works and where there may be a risk for the operators. So if your insurance broker calls and wants to talk to you about your insurance policy, take the call. He's not trying to sell you more insurance. He's making sure you have proper coverage to begin with. And if you make a change in your business, make sure you let your insurance broker know. I've got fortunately or unfortunately, I have clients that own multiple properties. And all of a sudden, I'll find out they bought a new property, not because they told me, but the bank inquired about their insurance. So I got to call them up and go, hey, what the heck did you do? Oh, yeah, I bought that about a month ago. Sorry, I forgot to tell you. I go, well, sorry wouldn't have helped. Had there been a fire on that building, there would have been no coverage. So I try to keep in constant contact with my clients so I understand what's going on in their business. Corporate, unfortunately, doesn't understand that this is not a numbers business. It's a people business. You have to build that relationship with the person. And unfortunately, I've gone through several account managers and have them replaced. And for an account manager to deal properly with a client, they have to understand their business. So all of a sudden they get a new piece of business and the client calls and they're at a loss. They say, well, I got to research this to get you the right answer. And I guess it's not a good thing to work with me. I've had my first account manager, she got pregnant and had her third child, so she was off. They replaced her with another gal. She got pregnant and she was off for 6 months. And then that one was replaced to another woman who had to go in for surgery and she was out on medical leave. So it's not safe to be one of my account managers. You may end up in the hospital or pregnant. And I have nothing to do with the pregnancies.
Oh man, Rick, everybody always enjoys comedy, especially when it comes to insurance, to lighten up the mood. So I appreciate that. That was hilarious. Rick, I do appreciate you coming on and getting us up to speed on what's going on with insurance again in 2026. We will have some more conversations. I believe next time we come on, we'll have a AI expert to actually talk about AI a little bit further. And again, we're going to have more of those conversations moving forward because AI is something that is growing by the day, and we just have to be prepared for it and know how to move forward. But again, Rick, thank you for joining us. We'll see you next time, bud.
My pleasure. See you next month.
All right. And for everybody that's watching, I want to thank you. I want you to think about this real quick. As Rick and I have alluded to, insurance is not meant to be the most alluring conversation that you can think of. Nobody really wants to talk about insurance. I guarantee when you see your policy, you do want to talk about insurance. You do want to find out what's going on. All these little details that happen to your business, you actually do want to know that next move in your business, who do I reach out to? I understand as business owners, we get creative. We understand, hey, if I add this to my business, this is going to explode. This is going to be a huge profit maker. I'll be able to hire whatever floats your boat. But when you make those decisions, understand there's a risk that's exposed. Your business has now become exposed in that manner. Please make sure that you're in a strong relationship, just the same relationship that you are with your accountant, with your insurance company, because they need to look at that and reassess your situation. Because again, that new business model, that new activity that you have could expose and take over your whole business. And we want to make sure that you stay in business and stay profitable, but make sure that you're properly insured so that way your business can be safe. I want to thank you all for taking your time out of your schedule to watch this program and get to know Rick a little bit more on what's going on with the insurance company. But Rick and I, we actually have to get back to work. So we'll see you next time. Thank you. Bye-bye.